Today I want to speak about something that is incredibly important to speak about when it comes to stocks. What is happening, investors? It is your boy Jack. I am not a financial advisor, and today we're going to be speaking about what creates business value. So I think we know that there's a lot of different kinds of investors. You can take two of the greats. You can look at Cathie Wood and the team over at ARK Invest, and you can see that they have entire ETFs dedicated to innovation. They will use a lot of potential value when deciding what companies to invest in. That's why you'll see them investing often in pre-revenue startups, etc., etc. Then a stark contrast would be somebody such as Warren Buffett, who we are going to speak about in detail today, who only invests essentially based off of valuations, full stop. One of my biggest mistakes, I personally believe in myself over the last year, was valuing potential value over kinetic value or actual value, and that is something that I really want to speak about in today's video. I'm trying to become a better investor constantly. I really have been over the last year, and this has been something I have been spending a lot of time behind the scenes looking into and researching and trying to figure out how to get the best of both worlds. It's no secret that I'm a growth stock investor, but it's also no secret that my thesis has been continually changing, particularly over the last 3 to 6 months. And if you have been keeping up to date with the channel, you'll be aware that I'm not prioritizing or pretty much investing in anything that is pre-revenue as of right now due to the current market conditions, and this is a large reason of why. So hopefully this will be an interesting video to you guys. It's something a little bit different. We're not going to be speaking about individual companies or where the next 10x banger is coming from, but instead we're going to be trying to get information that, you know, will stand with you going forwards and help you make better informed decisions in the stock market. And if nothing else, hopefully it can just help give you a little bit of a different perspective, because I know from speaking with people every day, it's very, very easy to get caught up on one thing in the stock market, whether that's, you know, DCF, or whether that is looking for the next 10x biotech stock, whatever. But I think it's good to take a step back very often and ask yourself the difficult questions, such as what creates business value. So my friends, right before we do get into today's video, could I please ask you to hit that juicy like button? An early thumbs up really helps me out. Drop me a comment down below. Let me know, what do you value more when you're looking into a business? I mean, do you care more about potential value, or do you care more about raw valuation models? And please, my friend, if you are indeed new around here, consider hitting that juicy red subscribe button if you would like more videos like this in the future. Also, if you're interested in joining my private Discord group, that'll be the first link in the description. In there, you will get access to all of my buy and sell alerts. We have bought a few things this month. We have sold one thing as well. And if you like 2 free stocks on Webull, that'll be the second link in the description. You got to sign up and deposit $100, get yourself some free money. It's easy. So let's speak about it. What creates business value? Kinetic value versus potential value. That is what the base of this video is going to be premised on today. Some deals have actual value, cash flows, assets, etc. Think of the big guys. Think of Apple, think of Facebook. You can go and see years and years and years worth of growth numbers. You can see historically what quarters they do best, and you can see what product launches have done fantastic things for the company and how they have grown. You can use discounted cash flows, you can use asset liabilities, you can use a whole lot of different valuation metrics. And then there are other deals that have potential values. Okay, people, ideas, intellectual property, etc. We've seen this a lot with EV. A lot of EV companies that people have invested in over the last year aren't actually making any money yet. But we see these numbers about the total addressable market. We see their unique selling points. We see their intellectual property, and we see the potential value that these guys could have down the line. And that's where growth stocks really fall into things. Now, a lot of growth stocks are out there that are producing cash. Look at Palantir, look at Corsair, etc., etc. So a company definitely doesn't have to be pre-revenue to be considered a growth stock by any means whatsoever. But at the end of the day, you can't put a monetary valuation on total addressable markets, on projected percentages of those markets that a company will indeed capture, on their intellectual property. You can make assumptions and educated assumptions, but you can't guarantee it. Whereas you look at a balance sheet, you see the exact amount of assets the company has, the exact amount of cash on hands, long-term debt, etc., etc. What a buyer or investor is willing to pay for the latter versus the former is entirely dependent on their strategic fit. And that is why oftentimes growth stocks trade at higher valuations, higher PE ratios, forward PEs, whatever it is, because people are willing to pay a premium for these ideas, for this potential value that may be created down the line. And personally, I think it's very important to take both of these different kinds of valuations together when researching your growth stocks in particular. So kinetic valuations, okay? The value of a business or asset with respect to the cash flow produced by the asset or business. Straightforward stuff. Again, you look into any of the FANG stocks, any stocks that have been around for more than 10 years, this is what you're going to be looking at primarily. Potential valuations, okay? Potential value is the stored value in an asset or entity because of its unique market position or configuration. Again, let's use Palantir as an example. People now think they could be the biggest software company in the entire world. They have access to data that many other people don't. They have contracts that other people are never going to get. Kinetic value of business is relative to other cash flowing and non-income providing assets and businesses in a similar sector. You don't go out there and compare the likes of Facebook to ExxonMobil. Makes no sense. And later on in the video, we're going to be looking at the math behind Warren Buffett's $3 billion stake in Apple all the way from back in 2016. And comparing Apple to Google's valuation at the time was one of the reasons why this investment may have been made. Due to the fact that they were in similar sectors, but Google was trading at a much higher market cap and much higher valuation. Transferability. Kinetic value can be transferred from one cash flowing business to another, whereas potential value cannot be transferred. Straightforward enough. Now, this is potentially the most important thing to keep in mind as we go forward in this video. The unit of measurement, okay, for Kinetic. Multiples of earnings, revenue, or customers. You know, actual things that we can measure. Whereas for the potential, it's in the eye of the beholder. And this is where things can get dangerous. And I don't say that as somebody trying to take the moral high ground, because I have been here. And I am doing my best to fall somewhere in the middle of these things as of right now. Again, guys, this is a journey. I'm trying to get better every single day. Now, as somebody who has a YouTube channel and as somebody who reads hundreds of comments on a daily basis for the last year or so, I see this. Every single day I'll get comments speaking about different companies. Some of them will have a $50 million market cap, and somebody says they're going to go to 500 million within a year for little to no reason, no research, no multiples, no values, no anything. And then we'll see them about Facebook, and people are saying that, you know, they're going to half in value, or they're going to 1.5 in value over the next 3 years. I think that valuations in the eye of the beholder could fall over here as well, because I want to make something straight. Just because you look at the Kinetic valuations of companies, because you look at PE ratios, discounted cash flows, etc., doesn't mean you can predict exactly what's going to happen and when it's going to happen. And I think that's something that is important to understand as well. This is just potentially a safer bet. And the determining factors behind these, obviously, for our Kinetic: total EBITDA, NWC, other balance sheet items. And for the potentials, the TAM, the SAM, the assumed penetration. Remember when you're looking at all of the SPACs and you always get to, you know, they're speaking about the total addressable market. They're speaking about what percentage of that market they expect to have, and that's how they justify their valuations. So keep all of these things in mind. I think we all know that last March there was a huge influx of new investors. I am included in that category. I'm not trying to speak down on anybody whatsoever. And the large majority of these guys were more interested in fast money or high growth opportunities. And again, I don't think there's anything wrong with that. I still am interested in the higher growth. If not, I just put all my money in the S&P 500 and forget about it. But I think a lot of us spent too much time just looking at potential, okay, as opposed to the actual facts and figures. And that led us astray on several different occasions. One thing I'd like to speak about is this, as I showed you guys earlier, the math behind Warren Buffett's $3 billion stake in Apple. So this was back in 2016 when they initially invested. And to this day, Apple is still the biggest holding in Berkshire Hathaway by a long shot, comprising of close to 40% of the overall portfolio. It's a little bit less now because they have sold some recently, but it's still an absolutely huge percent. So when we read through this, we're going to see why Warren Buffett invested for the growth potential. So back then, May of 2016, Apple released impressive quarterly results. $57.8 billion in revenue, 51 million iPhones sold, 26 million iPads. It goes on and on. So how should we value Apple? For the record, okay, in their most recent quarter, April 28, revenue was 89.6 billion. So the growth has continued to be huge for this company. Back then, if you looked at any valuation for Apple, example their PE or EBITDA, it is remarkably low relative to its competitors. Google had a PE of 32.2 while Apple was at 12.6. Back then, if Apple had Google's PE, it would have been worth $1.2 trillion. The Buffett model is important because it will tell us what assumptions we should analyze to determine Apple's value and ultimately its multiple. The model is straightforward. A company's value is based on its ability to generate future cash for its owners. We can analyze Apple's owner earnings by taking its net income plus depreciation and amortization less capital expenditures. The number was 34.7 billion for the 2013 fiscal year. So here we have facts and figures. We're not worrying about the potential side of things yet. This is black and white right in front of you, available for anybody to see. You don't have to make any assumptions at this stage. Now, the key to the Buffett model and any valuation model is projecting the growth rate of the owner's earnings number. So again, here, to an extent, this is potential. We can follow trends, but you are making assumptions. If we assume a further growth rate, we can determine the company's value. If we assume that Apple will grow its own earnings at 5% for the next 10 years, and then 2% for all years after that, Apple's market cap wouldn't be 453 billion. It wouldn't be 1.2 trillion. It would be 3 trillion. That's at just 5% annual growth for Apple. So one thing I want to say is you can find companies you love and it doesn't necessarily mean they're the best investments. Back in 2016, if you directly compared Apple and Google and you loved both of them, but the Apple valuation made sense, why wouldn't you go with them? It seemed like the safer bet. And if we look at the 5-year chart, Apple's up 411% and Google's up 232%. Both of them have done extraordinarily well. The valuation was already quite high for Google back then. I think this is so important for us growth stock investors to understand. We can't just invest because we believe a company will do well in the long term. The valuations do have to make sense when compared to their peers. For the short term, yes, okay, hype, excitement, Wall Street bets, whatever it is, do your thing. You can make money short term. But for the long term, just because you like a company doesn't mean it's the best investment out there. And that's something that we need to understand. From 2004 to 2013, Apple grew at a compound annual growth rate of 74%, meaning it grew our owners' earnings basically 74% every year. That's impressive, but not likely to continue forever. Remember, in the example these guys were using, they're saying it's going to be 5% and then 2%. Back then, these guys were saying the market is undervaluing Apple's ability to produce future cash flow. So understanding this growth rate assumption is critical to our assumptions. April 28, 2021, Apple earnings. Services and Mac revenue reached new all-time highs. Back then, Apple were disruptors, and one of the very important things when it comes to the potential of Apple back then was them being the disruptors, not allowing a different company to come in and do the next big thing, but Apple staying on top of it. And so that 5% or 2% could have been upgraded hugely if you took potential valuations into account as well. But ultimately, in 2016, when Warren Buffett, Berkshire Hathaway did invest in the company, they were a company with a track record of growing at 74% per year. They had years of data. A company that knows how to disrupt its own products better than any other company. And that stands true to this day, 5 years on from this article being written. A company that knows how to focus on the customer's job to be done. And a company with a 90% product launch success rate. And it really was that simple. And here we are today, Apple being the biggest company in the world. Now, the reason I used Apple as this specifically was because you can see both Kinetic valuations and potential valuations coming into one. And I don't think one can ever truly exist without the other. You really do need to use both of them in unison if you want to become a better investor. In my personal opinion, you don't have to agree with that statement at all. But for me personally, that's exactly what I am trying to do right now. That's really what I wanted to say in today's video. I really do hope that this was thought-provoking to at least a few of you guys. I know it's a different one. I know there's not as much screaming, shouting, whatever. I know there's no juicy picks here, but hopefully the value will stick with you guys for a long time. If you watched this video all the way till the end, perhaps you did take some value or a bit of entertainment, could I please ask you to hit that like button, as it really does help me out. Drop me a comment down below. Let me know what you think about the things we spoke about today. And please, my friend, if you're new around here, hit that juicy red subscribe button. Again, if you're interested in that private Discord group, that'll be the first link in the description. And if you would like those free stocks on Webull, that's the second link. But if you watched all the way till the end, you, my friend, are a true legend. I hope you have a beautiful, blessed day. I'll see you for another video very soon. Peace.